So in this video, I'm going to show you how to make a Forex trade. Now, I'm going to show you everything that you really need to know to make a Forex trade very fast. And now, just here on your MT4 or MT5, after connecting your MT4, MT5 with your broker, if you don't know how to connect your MT4 or MT5 with your broker, check the link in the description or the second episode of this very series. We did how to connect a broker and your MT4. So I assume you connected your broker and your MT4 and MT5 and you want to make a trade. Now this is how the platform looks like on your homepage. You are going to come and click on trade. When you click on trade, you are going to open this one here over here. So I'm just going to show you how you can place your trade. When you're going to place a trade, you're going to see a plus button above here. You're going to click on that very plus button. Of course, I assume that you have money already on your account balance, whatever, whether it is a demo or it is real money. I want to just show you how you are going to place a trade. So when you click on that plus button, there are some few things that I need to explain to you. So over here is the contract that you are trading, the currency that you are trading, the currency pair that you are trading is just up over there. Now that currency pair that you are trading, there are so many currency pairs that you can trade, but if you want to change, you click on this dollar sign over here, you click on that dollar sign above there, and you'll be able to change anything that you really want. So you are going to be able to click on this dollar sign above there. When you click on it, you can change from all. Now here I'm going to change from Euro USD. I'm going to change from Euro USD to GBP USD over here for a currency that I'm going to trade. Now we have finished that one. Another thing is that you want to do is where you are seeing instant execution. Now we have different order types that I cannot explain all of them in this very video, but when I click on instant execution, you can see the order types that we have. So the first one is instant execution. It means that if the price that, for example, if you are trading GBP USD and the price is at 1.2547, if you click on instant execution, if you click on instant, it simply means that you want to trade at that very price, whether you are buying or selling at that very price. You want an instant execution. But when we talk about the buy limit and then the sell limit, I want to explain those ones very fast because they are the second common one. So when you are talking about buy limit, the buy limit and sell limit, let me first explain the buy limit. What does it mean if you are going to use buy limit? What it means that if, for example, this is our chart, if this is our graph, and the price is over here, if you place a buy limit, simply, for example, you took this price here to be a buy limit, it will simply mean that you are expecting price to come to this, to come down a little bit and click on or bang your entry price. This would be your entry price. So this buy limit means that price is going to come from above to come down and then get your order executed, and then it will go up. That's how your analysis will be suggesting. And that's how a buy limit is. Simply, the buy limit is when the price is still up, but you're expecting the price to first come down a little bit so that you can enter into the market, and then you are projecting that the price is going to go up. So it is the opposite of sell limit. The opposite of sell limit, again, the price is down. For example, if this is the price, so this is sell limit. Let me put the sell limit here. So for sell limit, again, the price, if this is the curve that we are dealing with, the price is already down, but you are seeing that as the price is going to continue to go up, according to your analysis, maybe you feel that there is a resistance and the price is going to go into the resistance, and for you put an order here that when the price gets in, it should get you into the trade, and then you are expecting, or according to your analysis, you feel that the price is going to come down after getting to this level. It might be a resistance. So this order that you are going to put, the type of order you're going to put so that the price can be waiting for you over here, this order can wait for you over here, is called the sell limit, where you're expecting after you getting activated, the price is coming down. So the price, mainly at the time of you making that order, the price is below, the price is down here, and you make the order above the price. So it is the opposite of buy limit. So those are the two most common types. So I'm going to do an instant execution order. So so that you see how it really works. Now, for an instant execution order, I told you that you are just going to go with what the price presents. So what you are going to do now, you have an instant execution here, but for you to place an order, there's this thing here, that these numbers that you are seeing. Now we call those numbers lot sizes. Now before you make any forex trade, you need to understand what a lot size is. Now there's what we call standard lot size. So lot size, lot size, you need to understand what a lot size is. So let me explain to you what a lot size is. Now we have standard lot sizes and standard lot size. A standard lot size is 1. What is a standard lot size? A standard lot size simply means that for the base currency or the port currency, when you have this GBP USD in the GBP USD, on this GBP USD, if you are going to use one standard lot size, it means you are buying units of this currency here. You are going to trade the units that are going to be equal to 100,000 of this currency here, the units that you are going to use to trade. So simply, you put, when you are talking about lot sizes, put that one standard lot size that you are seeing here. For example, in this case, or any, it is representing 100,000 units of the currency, of the second currency that you are, of the second currency in your currency pair, and in this case it is USDT. So I'm going to be using dollars here. I'm going to be using dollars, referring to pairs that have USD as their second, in the pair where USD is like their second currency. So one lot size is equal to 100,000. So it means it does not mean that you are going to be trading with only one lot size. Otherwise, you can change this lot size to any lot size. You can use 2, 10, 100, but also you can use the last one. You can reduce and say 0.1. So 0.1, it is called like, it is like a mini. You like when you use 0.1 is equal to 0.1 is simply you are going to be trading worth 10,000. You are going to be equal to 10,000. So I'm going to explain this. Just know this is like a mini standard, and then you have the micro standard. You have also 0.01. So you can have 0.02 any number, but just know for you to convert to any number of lot size, always remember this, that one standard lot size is equal to 100,000 US dollars, or 100,000 of the second currency that you are in that currency pair that you are trading. But what is important to know when you are dealing with lot sizes is that when you are dealing with a standard lot size like 1, it is going to represent this amount of money. This is the amount of money in the back end that you are using for that particular trade. And if this is the amount of money that you are using for that particular trade, we need to also talk about, when you are talking about this, for some brokers, you find that this is the minimum amount, this is the minimum lot size that you are going to be using. And when you talk about this minimum lot size, it means that you are trading with 1,000. This 0.01 is the same as 1,000. So when you're dealing with this currency pair, it's the same as 1,000 USD. Now, in this case, people are going to be wondering, very many newbies who are going to be wondering that it means when you're going to trade, it needs a lot of money. It does, because if most of brokers, this is going to be their minimum amount they can allow you to trade, and that is 1,000 US dollars. How are you going to trade? You can trade with actually small amount of money that you don't know. There's what we call leverage in trading. It's what allows you to make these big orders with small amount of money. For example, if we have a leverage of 1 to 1,000, there are brokers that can give you a leverage of up to 1 to 1,000. I'm going to be putting the link in the description below for those traders that can give you big amount of leverage. The brokers, I mean. So it means that if you have 10, for every $1 that you have, the broker is willing to give you $1,000 if you have that leverage. So if I have $10 in my account, it simply means for this $10, I'm going to be having 10,000, because 10 times 1,000 is 10,000. So it means with this leverage, now this is the amount I have in the back end, and I can carry out this lot size. I can carry out 0.1 lot size, yet I only have $10. So I wanted to explain to you what leverage is, but for more details, leverage will be for another tutorial. But today we are talking about how to place a lot size. These are some of the things that you really need to know before you make the trade. So that this this is how we are going to be calculating our leverage and the lot size that we are going to be using. So when you're talking about lot size and you talk about leverage, those are the things that you are supposed to know before you place in a trade. So if I'm going to place a trade of one standard lot size, and I put 1, it simply means that in the back end I'm using $100,000. But what does it transform in form of profit and loss? When you use one standard lot size, for every profit that you make, or every 1 pip, for every pip is the steps that the market takes in trading. When the market is moving, it moves in step. 1 step, 2nd step, 3rd step. Those steps that the market moves in, we call them pips. Now, what are pips? I want to explain what a pip is so that you understand. Now, we gave an example that, for example, if the price of GBP USD is 1.2547, if the price of this pair GBP USD, if the price goes up by 1 step, it becomes 1.254. This is 7, it becomes 8. Now you can understand that it is only this number that changed from 7 to 8, so we call that 1 step. So the change that has changed from 7 to 8, it is 1 step, and that 1 step is called a pip. So this is what we call a pip. So if it reduces also, when this is to the upside, but to the downside, it becomes 1.254. This has been 7, so it becomes 6. So it has become 1 step downwards. So these are the movements that it moves. We count them in form of pips. And a pip in a number, in a currency that like GBP USD that has 4 decimal places in most cases, or 5 decimal places, the 4th decimal place you count from 1, 2, 3, 4. This 4th decimal place is where we count our pips from. This 4th decimal place, they change. This is what we call a pip. This number is where we calculate our pips from. So it means if you take a one standard lot size, let us calculate the difference between this. If it goes up in our favor, when you take 1.2547 and it went in our favor, it was let me say it reduced to 1.2546. What is the difference? We want to get the difference. So here we get 0. Here we also get, we start from the left hand side, of course. 7 minus 6 is 1. So here 0. 5 minus 5, 0, 2, 0. So we have 0.001. So this is the number that we have. This is the difference between the movement that we have had. So if we have, just follow. I'm going to show you why am I doing this so that you can understand the profit and loss if a market is moving. So it means this one movement, the one step, we have this difference in price. This is the difference in price. The price has only moved by 0.001. So if it has moved by 0.001 in our favor, 0.0001 in our favor, times, let's say we said we used one standard lot size, and one standard lot size we said is equal to $100,000. So $100,000. I want to calculate that if it moved 1 step in your favor, how much are you making? So when you calculate $100,000, you can use your calculator. Make sure you use your calculator. When you use your calculator, you are going to find that you are going to get $10 here. You are going to get $10. You can use your calculator. Please multiply your calculator for me. The way they taught me, you can just use this, and you'll be able to get the answer. So make sure you use your calculator. Let me also use my calculator here so that you can follow up. So I have 0.0001 times 100,000. You can see that my answer is 10. Meaning, if the price goes in my favor by 1 step or by 1 pip, I get my profit to be 10. Of course, it can vary, maybe the spread of the broker that you are using. That's why you need to have a broker with good spread. And the broker with good spread is in the link. The link is in the description below. The broker that for me I've used and has good spread. Check the link in the description below. You get a good broker that is going to give you. So sometimes you find that your price is like fluctuating or is not the same just because of the spread. But according to our calculation and the standard amount you're supposed to get when price goes in your favor with one standard lot size is $10. But if it goes against you also, one step, the way we saw, one step only, you are losing $10 if you use one standard lot size. So with this analogy, you can calculate your profit and loss using this lot size. Calculate your profit and loss, and understand that if you use one standard lot size, how much are you making for one step or one pip? You're making $10. So if I use two lot size, it means it is multiplying by 2. For every step, I'm making $20, but also for every step, it can be a plus or minus. I can get $10 or I lose $20 if I lose 2 lot sizes. So if someone uses 10 lot sizes, you have to just multiply those 10 lot sizes. You have to just multiply the 10. It means every lot size is 10 times 10. So it means every step, the person who uses 10 lot size is making $100. And also, if it goes against him, is losing $100. So we have understood what that is. So let us go back to our trading, and we see the instant execution. So I'm going to place a trade. I'm going to place a trade with one standard lot size. When I place a trade with one standard lot size, if you in your trade, when you have analyzed, you need to analyze your stop loss. You also need to analyze your take profit. So here you can put your stop loss. You just add your stop loss from your analysis, and here you can put your take profit, all from your analysis. So when I after putting everything, your stop loss, you can now place, if you have analyzed that it is going to go down, you place on a sell. If you analyze that it's going to go, your analysis shows that it's going to go down, you place a sell. If you have analyzed that it's going to go up, you place a buy. So let me just place a buy for the sake of showing you how it runs. So I place a buy, so it is going to run, and you can see it is rejected. You don't have new quotes. Let me get a new quote. Let me just set up mine so that I can get everything done right. Yes. USD. Yes. So I'm going to place my trade, right? And it is done. So I've placed my trade and it is done. You can see right now I've placed a trade on GBP USD. I placed a buy trade and I placed a one standard loss size. This is how you see your profit and loss. So I'm already up in profit by $6. It is already going up, and right now it is coming down. So you can see how volatile the market is. Whenever you're making any trade, you need to know risk management. Risk management is a topic for another